Hi, welcome back to another section with us on our accounting discussion today. So, as part of our discussion on accounting, from the beginning part, we have been looking out for what an accountant is. We have been talking about the key functions. We have discussed a lot on accounting. So today, we're also going to look out for one aspect or one function of what? Accounting, which help us to be able to enter transactions in the books of accounts. And if you remember, when we were discussing the definition of what an accountant is, we said that accounting is a process of what? Identifying, measuring, and recording of economic events quantified in monetary terms. So as part of our lesson today, we are going to look out for one of the key functions that help us to be able to enter transactions in the books of accounts. And we are going to focus that on what we call recording. Recording. So recording is one of the key functions when it comes to what? Entering transactions. And this will lead us into what we call what? An accounting equation. Accounting equation. Accounting equation. So, accounting equation form the basis of recording of what? Business transactions in the books of account. This accounting equation is being supported by a concept called the duality. We call the duality concept. Duality concept. If you remember, in our previous lesson, we learned about these concepts, accounting concepts and convention. And we said that when it comes to duality concept, remember, when it comes to recording of what transaction in the books of account, it must have fed the books twice. You must have what? One side and another side. You must have fed the books what? It must have fed the books what? Twice. And we'll get into that principle very soon. So, accounting equation being supported by what? A duality principle, which says that when it comes to recording of what transactions, it must have fed the books twice. Now, what is then this accounting equation you are trying to bring on board here? When we say an accounting equation, let's put it in this way. You understand the meaning of accounting, you also know the meaning of an equation, but let me shed more light on that so that you get to understand the whole deal when it comes to an accounting equation. Generally, you know that when we say an equation, it means that we are talking about two items on the balance. Two items on the balance. So for instance, let's say I have 4, and I say that 4 is equal to 4. That means on the left, on the right, both are what? Equal. On the left and on the right, both are what? Equal. This is what we call an equation. But if I have on the left 3 and on the right I'm having 4, then we can say that 3 is not equal to what? 4. It doesn't make an equation. But when it comes to an equation, we expect that two terms or two items on the left and on the right should what? Agree. And for instance, we can say that this is an equation, but this is not an equation. Good. So if that is the case, then what is this accounting equation that we are trying to what? Explain to help us in the recording of what? Business transaction. If you remember, when we're discussing the summary part or the brief part of the financial statement, we did make mention of the fact that when it comes to preparation of the financial statement, we have 5 elements that are pivotal that helps in the preparation and presentation of the financial statement. And these elements, we discuss them as being what? Assets, right? Liabilities, or liability, assets, liability, we also mention the fact that we also have what? Equity. So these are the elements when it comes to the preparation and presentation of the financial statement. We have assets, liability, equity, revenue, and the expenses. And as part of our discussion on accounting equation, these are the things that we'll be facing when it comes to an accounting equation. So what is then an accounting equation? Somebody may ask. Now let's take it in this way. Let's assume that you started a business, let's say a transport business, to convey what? Passengers from one place to what? Another. That's the business that you have started with. And then within this business, since a transport business, you need a vehicle to convey passengers from one end to another. So you being the investor or the owner, you came out with what? A motor vehicle, or let's say a vehicle that costed what? Let's say 10,000. 10,000 Ghana cedis, right? And at the end of the day, remember that that business that you operate is a company business. It's a company. I mean, limited liability what? Company, which is also being managed by what? I mean, a group of people called management. And if you can remember in our discussion on the accounting concept, we did make mention of the fact that we have a concept called what? Business entity concept. We are bringing that here. Now we have invested what? 10,000 as what? I mean, a capital with a supply of what? Commercial vehicle or motor vehicle to convey passengers from one end to another. You being the investor that you have invested that amount of 10,000, we call this 10,000 as what? Capital. We call it as what? Capital. We call this as capital that you have what? Invested. But remember that as we discussed on business entity concept, we said that when it comes to business, we have for two parties at work here. We have the investors or the owners, and we have what? The management. So the capital that you provided to the business is going to refer to what we call an asset. Going to refer to what we call an asset. So you have provided 10,000 worth of vehicle to be used, I mean, to convey customers or let's say passengers from one end to another. We call that as what? Capital. Let me write it all. We call this as what? Capital. Right? But to the business that this vehicle was brought to, we refer that as what? An asset. So at this point, we can say that our capital is equal to what? An asset. This means that here, the owner or the investor is only the sole person who is responsible for providing the capital of the business. And as we said, in the business entity concept, since this vehicle is going to be run by management of said transport business, we refer to that capital as what? An asset. If you remember, in our summary definition on our previous lesson, we said that assets are resources controlled by the entity. The business is the management going to run what? The usage of what? Such what? Asset that you brought. So to you, it's referred to as capital, but to the business, it's referred to what? An asset. So this is what we call the accounting equation. So on one aspect, you are providing the capital, which is going to serve as an asset to be used by what? The business, right? So here, the accounting equation is that all the resources that has been provided by the owner should be equal to the assets that exist in that business that you have what? Just started. But now let's take it a bit further. Let's say that now the business has expanded in size and then now more shareholders or investors are coming on board to, invest in that business. And because of that, you wanted to what? Go for what? Bank for what? A loan. You wanted to go to bank for what? A loan. What happened then is that you went to AA Bank, and then they contracted you with a loan of what? A loan of 7,000 Ghana cedis. This loan of 7,000 Ghana cedis, we refer to this loan as what? A liability. Refer to this as what? Liability. We refer to this loan as what? Liability. As liability. Why? Because this is a loan that somebody or other party also giving to you to run your business. So in this case, the accounting equation is going to be, we will have what? The asset, or let's take it from here, we will have what? The capital. You being the owner that you supply. So we have the capital, okay, plus what? The liability should be equal to the assets that exist in the business. Should be equal to, so we have C plus L should be equal to what? A. This is what we call the accounting equation. So accounting equation is saying that when it comes to resource provision in the business, we may have the owner supplying all the resources to be used to run the business. In that way, we'll have what? The capital being equal to the asset. But in a situation where the resource of the business is being supplied by partly the owner and partly what? The outside what? Shareholders or outside what? Group of people, then we will have what? Capital plus liability being equal to what? An asset. This is the concept of the accounting equation that we ought to understand. So now we have introduced what we call what? Assets, capital, liability. Remember, these are also the elements of the financial statement that we discussed in our summary discussion on the introductory part of the accounting. So we did mention of the fact that what are assets? Let's take it one by one so that we can take it from there. So we have assets, we have liability, we have capital or equity, we have what? Revenue, and we have what? Expenses. So what is then an asset? If we say an asset, what is an asset? In a layman understanding, we say that assets are a resource that somebody owns, that are used in the production of what? Goods and services. That is a layman understanding. But when it comes to a professional definition, we will say that assets are resources controlled. Assets are what? Resources controlled. Assets are resources controlled by the entity. Assets are resources controlled by the entity, right? Which has the potential of providing future economic benefits for the entity. That's what we can say when we talk about what? An asset. They are resources controlled by an entity as a result of what? Past events from which future economic benefits are potential to be received by the entity. That is what an asset is. So when we hear control here, the control here comes in where it's in the concept of business, and it says that when resources are provided by the investors or the owners, it is a business that will control the usage of what? Such asset. That's why we say that assets are resources controlled. So it's not the owner who's going to control the usage of the resources, but rather it's the business. That's why you say assets are resources controlled by the entity as a result of past events from which future economic benefits are expected to flow into the entity. So that is the definition of what an asset is. But when it comes to assets, we may have two forms of assets. We may have what we call what? Current assets, and we also have what we call the non-current assets. The OG term, we call it the fixed assets. So we have current assets and we have the non-current assets. Let's start from the non-current assets or the fixed asset. What is a fixed asset? What is what? A non-current asset. We are saying that these are assets which are used in the production and run of the business, whose effect in terms of duration will last beyond what? One accounting period. So this one, the benefit and effect goes beyond what? One accounting period. So it goes beyond 1 year. It goes beyond what? 1 year. And what are some of the examples of these assets that we are talking about? Here we can have what? The general from the PPE, property, plants, and equipment, according to the IAS 16. These are the non-current assets. They are real assets. They are real assets. So here, its effects always will go beyond what? One accounting year. They are used to help in the running and the management of what? The business. But we are saying that its usage and benefit goes beyond what? One accounting year. That is an idea about what we call what? A non-current asset or fixed asset. But when it comes to the current asset, that is the opposite. These are assets that helps in the run, the same thing helps in the running of the business, but whose benefit lasts within what? One accounting year or lasts within a year. So benefits last within a year. So benefits last within what? A year. Last within a year. So just 1 year and then it expires. What are some of the examples? We can talk about what? Stocks. We can talk about debtors. We can talk about debtors. Okay? We can talk about what we call cash. The cash itself is also what? A non-current asset. We can talk about cash or check, yes, or bank. Most of the time we refer to that. And then we can also as well talk about what we call prepaid expenses. We will explain all these issues as we move along. So these are the issues when it comes to assets. So we have current assets, we have the non-current assets. We will explore it better as we move along. But for now, let us know that assets have two divisions, current assets and the non-current assets. The current assets is being supported by the PPE, IAS 16, International Accounting Standard 16, property, plant, and equipment. And when it comes to the non-current assets, we have stocks, we have debtors, we have cash prepaid here and there. This one consists of, different standards that will be applicable. But we are not discussing standards in this view, but just to throw a hint that going forward, we'll look at some of these issues going forward. So that is what an asset are. Assets are. What about liability? When we say what is a liability? In simple terms, when we say liability, a layman understanding will say liability are what? Something that you owe. So if, for instance, I owe my friend, let's say, 20 Ghana cedis, to me it's a liability. It's a liability to me. Until I pay, I'm still in debt. So something that you expect to pay in the future is what we call liability. But in a professional definition, we say the liability is a present obligation. It's a present obligation. Because you own the person, any time that you pay within that is what present. So we say the liability, try to clean some part here. Liability a present obligation. A present what? Obligation. One aspect is that it's a present obligation arising from the past, the settlement of which is going to result in an outflow of future economic benefit embodying the entity. Whilst we said that assets are resources controlled by the entity from which future economic benefits are expected to flow into the entity, when it comes to liability, it is a present obligation arising from the past, the settlement of which is going to result in an outflow. Whilst assets are an inflow, liability is what? An outflow of what? Future economic benefit embodying the entity. This is what we call what? A liability in a professional definition form. Something supposed to pay now that occurred in the past, right? Which will result to an outflow, something going out from the business in the form of a settlement, right? Settlement of debt or whatever it is, which, before that forms part of the future economic benefit of the entity. This is what we refer to as a liability. So when it comes to liability as well, too, we have two divisions. We have what we call what? We have the current liability, and we also have what? The non-current liability. We don't have fixed liability, no. We call it what? The non-current liability. So current liability, non-current liability. It's also very simple. When we say current liability, as we refer to the assets, the same definition. Current liability to here, in terms of settlement, will last within what? 1 year. So will last within what? 1 year. We expect that when you have any debt to pay, which is current, supposed to last within what? 1 year. We also call it what? Short-term what? Debt. Short-term what? Debt. So current liability can also be called short-term debt. What are some of the examples of what? Current liability. We may have what we call what? Creditors. Creditors are a group of people that supplies goods or stocks to the business on credit. So we call them creditors. Creditors. So we have creditors. We also have what? Short-term loans. Short-term loans. We may have what we call overdrafts. Bank overdrafts. These are all current liability issues that we can talk about. Unpaid promissory note. All these things are part of what? Current what? Liability. The opposite is true, the non-current liability. These are also liabilities which are expected to be paid, which goes beyond what? 1 accounting year, which goes beyond 1 year. What are some of the examples when it comes to non-current liability? We may have what we call what? Mortgage. Mortgage. We mostly use this in more like collateral security issues. It comes in the mortgage. When you say collateral security, this is where you want to contract for some huge amount of money, but the condition is that we require you to provide what? A well valuable asset That will serve as what a mediator. Should in case we fail not to pay, then we can come for that asset, we'll sell it off and use it to settle, our debt. Whatever is left, we give back to you. So it's an aspect like that. We also have, debenture, long-term what? Debenture. It's also part of what? The issue about liability. So we have what? Debenture, debentures or debenture. We also have long-term loan, long-term loan, and the likes. There are too many issues or examples that we can talk about when it comes to what? The non-current liability. What about capital or equity? When we say capital or equity, let me start from the capital side. When we say capital, capital is generally resource that you use to start the business, you use to commence the business. So let's say you started a toffee business and you began with 1,000 cedis. That is your capital. That is your capital. So capital is what? The resource that you use to start what? A business. But when it comes to equity, so we have capital versus what? Equity. So capital is the initial amount that you use to start what? A business. The initial value of your business at the beginning stage. That is what we call capital. But when we talk about equity, equity has to do with what? Changes in what? The initial capital of the business. Equity has to do with the changes in the initial capital of the business. Per layman understanding, changes in the initial capital of the business. Equity. So now, when we say what is an equity in the professional definition form, we say that equity is a residual interest that is obtained after deducting all liabilities from the assets. So we say that equity is equal to the residual interest after deducting what? All liability from what? Assets. So when we subtract all our liabilities from assets, whatever is left is give us what we call the equity. The equity. So let's take note of that. So when it comes to equity, in general, equity has to do with changes in the initial capital of the business. Let's give an example. Let's say we started a business worth 10,000 Ghana cedis. But now, we can say that our capital at close, this is capital at start, capital at close is equal to now what? 110,000 Ghana cedis. What is happening here? The difference of what? That 10,000 that we are having here, the difference of that 10,000 we are having is what we call what? In general, we refer to that as what? Profit. We refer to this as what? Profit. We refer to this as profit. So at the beginning, we were having what? 10,000. But at the end, we are having what? 110,000. That difference is called what? Profit. So we'll call this capital at start as what? The initial capital. And this capital at close is called what? The equity. This is what we call the equity. The equity. So that means that equity, when we say equity, equity is equal to the initial capital at start plus or minus what? Profit or what? Loss. If it is plus, that means that we have capital plus profit. This will give us the equity or changes in the initial capital of the business. If it is a minus, that means we have what? A loss. That means we have a loss. That's going to be what? C plus what? Loss. Because we know loss is negative. So negative and positive means you still get what? Negative. Or better still, you can say that it is capital minus what? Loss. So when it comes to equity, equity has to do with what? The changes in the initial capital. So as always, every business seeks to make profit, but there are instances where you may make a loss. But at the backside of the business, they cease to make profit. So here we are going to direct our attention to the profit side. So that means that here, when we are talking about equity, we can say that equity should be equal to capital plus what? Profit. We are limiting our analysis on just what? The profit part. We can also get loss as was I've already explained. So that is the issue about the difference between capital and the what? Equity. As I said, in the professional definition form, equity has to do with the residual interest after deducting all liabilities from the asset. But in generic terms, equity has to do with the changes in the initial capital of the business. At start, it was 10,000, but at the end, we are having what? 110,000. The changes which has occurred by a difference of 10,000, added up to the initial capital give us the equity, which we call it as profit. Generally, we call it as profit. right? But the capital itself is the initial amount that used to commence or started the business, give us the capital. Now back to revenue. Back to revenue. What is revenue? What is revenue? When we say revenue, revenue in generic term refers to the amount of sales that we generated over a period of time. Revenue. That's generic terms. Amount of sales that we generated over a period of time. Over a period of time. But in a professional definition form, we say that revenue is the net increase, right? The net increase of what? Future economic benefits as a result of a decrease in what? As a result of a decrease in an asset, right? The net increase of what? Future economic what? Benefit. The net increase of future economic what? Benefit, right? The net increase of future economic benefit. When it comes to that of the expense, we call this expenses. Expenses. Expenses too in general term has to do with what? Any cost that you incur in running the business, cost incurred in running the business, cost incurred in running the business, or a decrease in future economic benefit as a result of decrease in what? An asset. A decrease in future economic benefit as a result of a decrease in an asset give us what we call what? Expenses. So let's take note of that. So once we have an idea about these elements that are pivotal in the accounting equation, now let's get back to our accounting equation or principle that we're trying to establish.